You are watching The Whale Flow, where we study markets not as chaos but as systems. In this episode, we look into the living core of blockchain's economy, DeFi, or decentralized finance, the heartbeat that keeps the entire crypto organism alive. To understand DeFi, we need to remember what finance really is. At its core, finance is simply the movement of money through trust. In the traditional world, that trust is provided by institutions, banks, brokers, and regulators, who record transactions and manage risk. In blockchain, trust is replaced by code. Smart contracts take the place of banks. Algorithms take the place of loan officers. Liquidity pools replace depositors. The entire financial system is rewritten in lines of transparent logic that anyone can audit and no one can unilaterally change. DeFi was born from a simple but revolutionary question: what if we could rebuild the financial system without intermediaries? The first answer came in 2018-2019 with protocols like MakerDAO, Uniswap, and Compound. Maker created stable coins backed by crypto collateral, giving the blockchain its first native form of money. Uniswap introduced automated market making, turning liquidity provision into a public good. Compound allowed users to lend and borrow directly through smart contracts, with interest rates set by supply and demand, not by a central bank. These were not isolated experiments. They were the foundation stones of an open financial architecture that anyone on Earth could access. By 2020, this idea exploded into what became known as DeFi summer. Billions of dollars of liquidity flowed into protocols across Ethereum. Yield farming was born, an incentive mechanism where users earned governance tokens for supplying capital. For the first time, ordinary users could act as market makers, liquidity providers, and bankers from their own wallets. DeFi became the proof that finance could run without permission. But with that freedom came new complexity. Smart contracts replaced humans, but humans wrote those contracts, and many were imperfect. Exploits and hacks appeared alongside innovation. It was a reminder that code is only as trustworthy as the minds behind it. If we look beneath the hype, DeFi performs the same basic functions as traditional finance: lending, borrowing, trading, saving, and insurance, but it does them in an open, composable way. Each protocol can connect to another like Lego blocks. A user can deposit collateral into MakerDAO, borrow stable coins, use them on Uniswap to trade, then deposit earnings into RV for yield, all within minutes, without asking permission from anyone. This composability is what makes DeFi powerful. It's not just a collection of apps, it's a networked economy where capital moves freely through code. The architecture of DeFi rests on three essential components: liquidity pools, governance tokens, and oracles. Liquidity pools replace the traditional order book. They are smart contracts holding funds that users trade against. Governance tokens give the community the power to steer development, to decide interest models, reward rates, and protocol upgrades. And oracles provide the critical data feeds, prices, exchange rates, and market conditions that make automated finance possible. Together, they form a transparent, self-operating financial system, one that functions 24 hours a day, across every border. Yet DeFi is far from perfect. The open nature that makes it inclusive also makes it fragile. Bugs in code can drain millions in seconds. Market shocks can trigger cascading liquidations. Governance can be captured by whales who hold most of the tokens. And regulatory uncertainty continues to hover over the industry. These are not reasons to dismiss DeFi, but reminders that it is still young. Every financial revolution in history, from the first stock exchanges to the rise of online banking, went through its period of chaos before reaching maturity. The deeper value of DeFi is not the temporary yield, it is the infrastructure of freedom. When you interact with a DeFi protocol, you are not asking for permission. There is no bank to freeze your funds, no bureaucrat to delay your transfer, no gatekeeper to decide who participates. Access is equal, the rules are public, the outcome depends on your understanding, not your connections. For billions of people locked out of traditional finance, this is not speculation, it is liberation. From a macro perspective, DeFi is also where liquidity in the crypto market begins its journey. In bull markets, capital enters through stable coins and is deployed into lending pools, liquidity farms, and derivatives protocols. From there, it spreads into other sectors: NFTs, game FI, social FI, amplifying returns and risk alike. In bear markets, the flow reverses, capital retreats to stable assets, yields compress, and DeFi contracts, but the core infrastructure remains. It's a living cycle of expansion and contraction, just like the heartbeat it represents. We are now entering the third generation of DeFi. The first generation built the primitives, lending, trading, and stable coins. The second generation added efficiency, yield aggregation, synthetic assets, and cross-chain liquidity. The third generation focuses on sustainability, real-world assets, on-chain treasuries, and risk management. The question is no longer whether DeFi works. It does. The question is whether it can scale responsibly, integrate with traditional finance, and survive beyond the hype. One of the most promising developments is the integration of real-world assets, or RWA, into DeFi protocols. Treasury bills, bonds, and invoices are being tokenized and used as collateral. This brings stable yields from traditional markets into the crypto ecosystem, anchoring it to real economic value. Another frontier is decentralized derivatives, where protocols like DYDX and GMX allow perpetual futures trading entirely on-chain. These innovations blur the line between traditional and decentralized finance, creating a hybrid system that may eventually replace the current one. For builders, DeFi remains the ultimate laboratory of financial innovation. For investors, it is the arena where understanding structure matters most. The yields that seem extraordinary are not free. They are compensation for risk, smart contract risk, liquidity risk, and systemic risk. Those who survive in DeFi are not the ones chasing the highest APRs but the ones who understand what they are lending, to whom, and under what rules. The same discipline that governs traditional markets applies here, only multiplied by transparency. As we look forward, DeFi's long-term destiny is to disappear into everyday life. The same way you no longer think about TCP/IP when you browse the internet. One day you won't think about smart contracts when you move money. Your bank account, your portfolio, your digital wallet, they will all operate on decentralized rails beneath the surface. The protocols you use today are the early prototypes of that invisible financial infrastructure. DeFi is not just the beating heart of blockchain, it is the quiet revolution in how humans coordinate value. It replaces institutions with algorithms, opacity with transparency, and privilege with access. It is imperfect, volatile, and still learning, but it is alive. And like any living system, it grows stronger through every challenge. This is the Whale Flow, where we study the structure of finance beyond the headlines, where knowledge replaces noise, and where those who understand how decentralized finance truly works will not only survive the next cycle, they will become the architects of the next economy.